And I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to ChaikinAnalytics.com/today, where you can sign up for a free email. Get daily stock ideas for you to consider in your inbox every trading day before the market opens. So U.S. equities finished higher in Thursday's trading, closing near the best levels of the day. All sectors closed in the green, led by energy and technology. Treasuries rallied again with the curve steepening. The dollar was under pressure versus the euro and the yen. Gold finished up 40 basis points, and WTI crude closed down 40 basis points for an eighth straight day of declines. Now, as we get to the desk this morning, futures are higher by about 10 basis points, reversing earlier weakness. However, U.S. equities are still on track for their third straight week of losses. Treasuries are weaker with the curve flattening. Dollars little changed against the yen and euro. Gold giving some back, down 40 basis points, and WTI crude rallying 1% here in the pre-market after those 8 straight days of declines. And it is Jobs Friday here. Payroll report came in 136,000 new jobs versus street account consensus estimate of about 145,000 jobs, and that's what's led the futures to rally here. And yesterday, for the S&P 500, we had a key reversal. Right at one point yesterday, we were looking to break down below that trend line that I started putting on the chart, looking at another 1% decline, but we got a key reversal ahead of that jobs report today. Now, support is near the August lows at 28.40 to 28.20. The 200-day moving average comes into play there as well. Resistance in the area between 29.50 and 3,000. The RSI bounced with the market to hold the 40 level, and Chaikin money flow is still bullish. So if we can get some follow through today and hold the index above the 2,900 mark, that would be a positive development for the S&P 500 here in the near term. Remember yesterday, that's what we said we wanted to see, a quick retake of 2,900 to keep this short-term trend intact. Shifting over now to our market in a minute. What are we talking about in our note today to Chaikin Analytics clients? Stock staged that key reversal, pushing the S&P 500 above 2,900 on the day. September jobs report really closes out what has been a week of poor economic data, starting with that ISM manufacturing data, got the services data or the non-manufacturing data yesterday coming in weaker than expected, signs of growth slowing or continued signs of growth slowing, and that's really what led to the back-to-back 1% declines for the S&P 500 before snapping that short streak yesterday. However, if we look under the surface of the market, defensive leadership remains a theme in our key relationships. We'll take a look at a few of those charts that highlight that theme. But also, one of the key charts that I love to look at, relative strength in semiconductors, is actually intensifying. So futures did point to a lower open in front of the jobs report, and now they have kind of snapped back and are, slightly higher. Taking a look at the major markets from a power bar perspective, still skewed somewhat to the bearish side, right? The Dow added 50 basis points yesterday, but still 6 bears to 2 bulls. S&P 500, 83 bips to the good yesterday, 109 bears to 72 bulls. NASDAQ was an outperformer, up over 1%. Power bar ratio still skews bearish at 25 to 16. Small caps, even in an up tape, were an underperformer. 465 bulls there for 400 bears. Big rally in bonds, sending yields lower, and that NASDAQ outperformance was driven by technology. Tech up 1.23% on the day. However, the power bar ratio does have a slightly bearish skew to it. 14 bearish or very bearish stocks in the tech sector for 10 bullish or very bullish stocks. According to the Chaikin Power Bar, small cap stocks have become somewhat more bullish than large cap stocks. The major markets are mixed. Let's take a look at our stock of the day now, because this is one that's always on a lot of people's radar screens. I always get a ton of questions about Micron, especially in light of that big gap lower following their earnings report last week. But Micron does have a very bullish rating at Chaikin Analytics, and that's due to very attractive financial metrics, very positive expert activity. There is some weak technical activity of late, but when we take the 20 factors, 5 in each of these 4 categories, we come out with that very bullish rating. We have a stock with a strong trend in a strong industry group. Now, this pullback following the earnings report last week has brought us to test support at the $42 level. Stock still does have that very bullish rating and is still an outperformer. Now, the outperformance is obviously diminished following that earnings report, but still an outperformer. Stock is now oversold based on our overbought, oversold indicator. But the hangup that I have right now is Chaikin money flow going bearish. And what's interesting to me is that money flow went bearish as the stock was trading up here near the highs. This was a sign that investors were using strength to sell the stock, and that led the decline in the stock following the earnings report. So I'd love to see a stabilization in money flow as a sign that this $42 support level is likely to hold. You have to kind of pick your poison on this one. If you're on the more aggressive side, I can't argue with it. The weight of the evidence supports Micron stabilizing. If you're a little bit more conservative, though, and want to wait for that money flow to start to improve, I can't argue with that either. Keep an eye on Micron here. It's a key name within the semiconductors, and we're going to take a look at the semis in just a little bit. Our sector tracker, movement of the major sectors over the last 5 days, even after yesterday's key reversal, all the major sectors are still negative over the past 5 days. And there's still that defensive feel to the top end of this list. Real estate, healthcare, staples, and utilities, all the defensive sectors of the market, all outperforming in a down tape. Discretionary tech, comms, and materials are middle of the road here. We'd love to see tech continue to build on yesterday's outperformance. Tech is over 20% of the S&P 500. Financials remain under pressure as yields fall. Industrials remain under pressure as economic data has been weak. And energy, as we said, oil down 8 consecutive days. That's obviously going to weigh on the energy sector, and the groups within that sector and the individual stocks within that sector remain bearish. This energy, I feel like, has been towards the bottom of the list for weeks now. Continues to be an area of the market that we want to avoid. Now, our industry in focus today is semiconductor services, and longtime listeners and watchers of this show know the importance I place on semiconductors as a key data point within the market. So over the past 6 months, they've been outperforming, up 2.85% relative to the S&P 500. Power bar ratio is slightly weak, though, with 10 bearish or very bearish stocks for 9 bullish or very bullish stocks. Earns it a rank of 9 of 21 subsectors, but it has moved up 3 slots over the past week. So in a situation like this, stock selection obviously becomes very important. If you are going to drill down on the semiconductors, you probably want to avoid the very bearish names within that group. Names like Advanced Micro Devices, AMD, I know that's a fan favorite. Qualcomm, QCOM, and Marvell, MRVL, all have very bearish Chaikin power gauge ratings. Let's take a look at the group now, though. XSD is the equally weighted semiconductor ETF. The fund does have a bullish power gauge ETF rating. Trend is weak, though, as it's fallen below our long-term trend line. I think we're at a key level. This is an inflection point for semiconductors, right? If we draw the trend line off of the lows from late 2018 and connect them to the lows from late in the spring, they line up with that trend line. Now lines up with the $85 level, which lines up with support throughout this consolidation. So if semis are going to bounce, this would be the level from which they should do it, especially with our overbought, oversold indicator in oversold territory. Money flow has remained bullish during this pullback, so that is encouraging. But for us, as a bigger picture data point for the overall market, I've boxed off what I look at on a daily basis. It's relative strength against the market. There's a positive correlation between relative strength of the semiconductors and the market in general. So when the semis are outperforming, the market tends to hold up and drift higher. When semis start to lag, that's when the market starts to come under pressure. So these mounds of green here are encouraging for the market in general. But as always, we want to skew to what is leadership within the market, and right now that's the defensive areas of the market. Let's look at what's trending right now. Yesterday's S&P 500 gainers and losers. LW up 6% plus on some follow through after their earnings announcement. Market Access gave out their September trading volumes. That sent the stock higher by over 5%. Nectar, this stock seems like a trader's dream. It's constantly on one side of this board or the other, up 5% yesterday as it rebounds. NVIDIA rallied with the semis, and Hess has a deal on the tape today. Stock was higher by 4% yesterday. On the loser side of the board, Constellation, STZ down 6% following their earnings announcement. No surprise here. Schwab Commissions going to zero across the board for the online broker, pressuring those stocks. Delta, some of their guidance as well as potential concerns about Airbus tariffs weighing on Delta yesterday, down 2.8%. Ulta caught at an initiation at Goldman Sachs with a neutral rating, stock lower by 2%. And Norwegian Cruise Lines announces a CEO transition to take about 2% out of that stock on the day. Let's dive in now to what I'm looking at. On Fridays, in my notes, Chaikin Analytics clients, I look at key themes and relationships which I think paint a picture and confirm what we're seeing at the sector and industry level. And right now, the key themes remain defensive in nature, right? And there's a few ways that I like to look at that. We're going to highlight a few of them here today. First, I look at high yield bonds and how they're trading relative to treasuries, right? If investors are in a risk-seeking mood, stands to reason that high yield or the riskier bonds would outperform the safety of treasuries, and that just has not been the case really since last October. This is a ratio. You can see the ratio made its high in last October and now has been in a downtrend for about a year, below a declining 200-day moving average. What's interesting to me is we're now testing what can be described as a key support level, or on the verge of testing what could be described as a key support level. So we're watching closely here as the S&P 500, it nears the lower bound of the August trading range, or has it as a key support level. Why do we care? Because there's a positive correlation between this ratio in the top panel and the S&P 500. What I have at the bottom of the screen here is the 63-day rolling correlation. And you can see that generally it's positive. So when high yield is lagging treasuries, that is usually a headwind for the overall equity market. And when high yield is outperforming, it's a tailwind for the S&P 500 and the overall equity market. It's a sign of risk taking in the marketplace. So as we get down here and test support, bullish investors would love to see this ratio hold support and begin to move higher and begin an uptrend that would provide a tailwind for equities. But right now, still very much pointing to risk off. Discretionary versus staples is another way that we measure the risk appetite of investors in the marketplace. And what we've done here is looking at both of these groups on an equally weighted basis. Because Amazon is such a large weight in the discretionary sector, we want to neutralize for that. So equal weight discretionary versus equal weight staples. And you can see discretionary has been lagging, and has been lagging since May of 2018, right? Solid downtrend below the 200-day moving average. Now kind of dancing with this support / resistance level, showing us a little bit of polarity in the marketplace. Again, bullish investors want to see discretionary outperforming staples as a sign of risk taking in the marketplace. Now, as we kind of dance with this key level, something that is jumping out to me is the fact that on this latest move lower, the RSI did not become oversold and is now trying to stabilize within bullish ranges. This is the RSI of the ratio. So to the extent that we can get a base to build here and start to move higher, that would be a tailwind for the equity market. However, if discretionary continues to lag staples, that would obviously be further sign of defensive positioning and continue to be a headwind for the market. Now, remember, the market's been choppy really for about a year and a half or plus, right? Since January of 2018, it's been a lot of choppiness within the marketplace, and this ratio definitely speaks to that dynamic at play for the broader equity market. And finally, we'll take a look at high beta versus low volatility. Again, same theme. If investors think the market's going higher and are risk seeking, they're going to skew towards the higher beta names. But when they're seeking safety, they're going to skew towards the low volatility names. And high beta has been lagging low volatility since last May, below the 200-day moving average. But the RSI again here is showing signs of potential stabilization. So the signs are there for a base to build in these key themes and relationships, but we're not there yet. They await confirmation. So the trends very much remain in place, but obviously we're watching them closely, because as they start to reverse, that could provide a tailwind for the equity market, especially if it holds this key level that we've been highlighting around 2,900. That's going to wrap it up for today. Head over to the site to sign up for that email. I hope you all have a great weekend. I will be back here on Monday.